South Africa's poor performance when it comes to saving money for retirement has been the focus of reform at National Treasury and the Financial Services Board. One of the reasons for the shortfall in retirement savings is that people have been saving too conservatively at different stages of their life cycle. Shaun Latter, the Managing Director at Quaestorwealth, joins us in the studio to discuss the topic. Thanks for joining us, Shaun. We get into this thing, I was sitting down with my wife over the weekend making choices around provident and pension funds, and obviously at her employer there's a wide range of options because the workforce is, includes everyone that's just started out and everyone that's about to retire. Do you think that perhaps South Africans have been saving a little bit too conservatively when it comes to retirement? I discussed this thing with my wife, and that people are kind of scared about the market when they don't understand it. So they elect to go conservative or, try and moderate the risk a little bit when, someone in their early or late 20s or early 30s should really be taking as much risk as possible.
Yeah, I think you're absolutely right. And I think the problem or challenge that's come in is as you said, the sort of idea of risk and what risk really means. So when one looks at it, and specifically when one looks at retirement assets, they look at it and they say, well, we need to be prudent with this money, which, on the first layer it makes perfect sense. When you look at the risk factor, however, going too conservative may well very much mean that you're not going to have enough when you get to retirement and perhaps to carry you through retirement.
Now we talk about these life stage models, which has been the kind of conventional thinking around getting people to the right amount in terms of having enough money to save at retirement. We're talking a little bit off air about how that's changing with both the concept of what retirement means for many people, as well as how you put a life stage process in place. I think just for the benefit of our audience, tell us what's meant by a life stage model and why that model's being challenged a little bit at the moment with changes to the way people think about retirement.
Yeah, Warren, I think just to take a step back is to say that if we look sort of 5 to 10 years ago in the industry, every fund that you looked at was based on either a conservative, balanced, aggressive, moderately aggressive. So everything had this sort of risk bias to it, and you selected according to that. As time has gone by, I think people have become a little bit more aware of that. And these lifestyle models, as you said, have become a lot more popular in that what generally you see happening is the younger the person is, the higher exposure they have to growth assets such as equities and property. And as time goes by, they slowly disinvest out of those growth assets, start moving into the bonds and cash type asset classes, which are seen as more conservative. So that's really the backdrop of what we had there, and I think for many people it made a lot of sense. Where it's getting heavily challenged now is that what we're seeing globally is the idea and concept of retirement is changing rapidly. So where you had somebody working potentially in a corporate from the age of 25 through to 65, 40 years service, and then they stop one day and go and sit on the stoep and watch the grass grow. We're not seeing that anymore. And the baby boomers who are now just in the second year of being retirees now are the ones that are challenging this and saying, well, potentially I don't want to retire. Or maybe I do want to retire, but slightly differently. So what you're seeing is a far more individualistic approach to how retirement is being dealt with, and therefore how it should be planned for. So the problem with the life stage modeling is it has everything to do with age and very little to do with circumstance.
And that age, so I mean in the traditional model you'd start off in your 20s with a very aggressive portfolio and then kind of moderate that, and then as you sort of got to the age of retirement, which traditionally has been 65, that would become a very conservative income generating portfolio. But now, I mean, on the other side of the coin, we've got this idea that demographically people are living longer as well. So how, when people think about this discussion, and I had this discussion with a friend of mine, is what is my average age going to be in 30 years time when I retire? Because you could have it could be the traditional, you look at an actuarial model and say, well, for a man my age it could be 79, but increasingly that age is going up. So is that idea of having a once-off retirement event still applicable at this point?
No, I think not. And I think that's the crux of the issue, is if we go back to where pension funds and the idea of retirement were really born, it wasn't that long ago. And what you generally found is that you had a life expectancy. When the first pensioners started coming into the fold, and now we're only looking sort of back to around the 40s and the like, is they're going to have a lifespan of 5 to 10 years. So the amount of capital that they needed to accumulate in that time was relatively a lot lower than what we have today. Whereas today you might have your full working career over again in retirement. So that brings up two very, very important questions. Number one, from a financial point of view, can I afford to, if I'm only saving 10 to 15% of my income in these 40 years, be able to spend 100% of it in those 40 years? That's the first side of it. And the second side of it is really around saying, if we are living longer, it potentially means we could also work longer. And I think that's where a lot of people are looking at it differently. That's the one element. The other side of it, and to come back to the whole life stage and how we save, is that, remember, there's a certain amount of restriction that's come in with Regulation 28 of the Pension Funds Act that says we can only have a maximum of 75% in my equities, even if you're 20 years old. And that's become a bit of a limiting factor, which means that before you could have gone a lot more aggressive early on, and yes, you could have slowly but surely got more conservative as you went along. Now, if you're starting out more conservative, it means that you're having to bump up that sort of almost risk capacity a lot more as you go down the line.
So I think just to bring this back to discussion, there's a lot of people maybe thinking about, now that we've come to the sort of end of the tax year, thinking about restructuring some of their investments and their portfolio, but specifically around people that are sitting with RAs and pension and provident funds. Is there still a case to be made that obviously you be aggressive as young as you can, and it's more the nearer part to retirement that changes more than anything else at this point?
Absolutely. And as far as possible, remember, when we talk about diversification and investing, time is a great diversifier. So if you've got a lot of time on your hands, then you can afford to take on more and more of the equities and the more volatile sort of asset classes. Which then brings in the next element, is one of the misconceptions that many people have is, as they approach retirement is sort of D-date, and they set it out and they're going, well, I've only got 5 years to retirement, therefore I should be getting more and more conservative and perhaps ultra-conservative. One has to look through that and kind of say, well, that's a date that's going to happen regardless. But it's not about the 5 years that you've got to retirement. One has to consider the potential 35 years that you've got after retirement. And suddenly the whole sort of time-based factor starts hitting home, and one has to say, well, if I'm now actually investing not for the next 5 years, but potentially for the next 40 years, sure, I can start taking on more of the market, and I can potentially be a little bit more aggressive, and I might need to be a little bit more aggressive in terms of having that money last for me.
So, and that's possibly where the life stage model could be flawed, is that as you take money out of the market, you may realize that you actually need to put it back in.
Yeah, absolutely. There's two elements to it. Remember the sort of wonderful law of compounding interest. The more as you go along you start taking out of the market, the less you're going to be able to benefit from compounding interest. So what happens is, in the last 5 to 10 years leading up to retirement, you might find that you're going to miss out on a huge amount of growth that would help your portfolio. That's the first side of it. And then sort of moving out from there, it's really around saying, if you're becoming, in many of the life stage sort of products, if you become too conservative, you're basically disinvesting yourself out of the market. Suddenly you find yourself retired and going, well, hang on, now I've got to go back into the market to get the returns that I need to fund my lifestyle.
We've been talking a lot to fund managers on this program that run balanced portfolios, and a lot of what they've been telling us, obviously with the situation we have with Europe and the developed markets having very low interest rates, fixed interest has almost become a non-event. So in the absence now of a life stage model, how do we think about the traditional asset allocation? I mean, is there even a space now for fixed interest? Because from what I'm hearing, what you're telling me, I should just, in my 30s, be thinking about building up a portfolio of stocks that pays dividends, and that eventually at some point when I decide to retire, there'll be enough in the form of income there to generate for me to live comfortably in my retirement. So How does this change the thinking around asset allocation, both pre and post-retirement?
Well, I think, like I said before, time is a diversification tool that not many people take on. And so you hit the nail on the head. The younger you are, the more time is going to work for you. So the younger you are, the higher you want to have your exposure to equities, absolutely. Once you start going towards and perhaps into retirement, what you have to consider there, and even if it is a thing of you're not going to get great returns out of fixed interest in the short term, you almost have to have that parking bay that sort of takes some of the bumps out of the market. Because remember, volatility in your early years is a non-event, okay? Because the capital sits there, you don't touch it, it can go up, it can go down, it can go sideways, it doesn't really matter. However, once you get into retirement, you're drawing from that capital, it becomes a little more challenging. So the more volatility hits you, especially on the downside, and you taking capital off and having to sell off those units to provide an income, that's where the danger might lie. So that's where you start seeing the risk assets such as bonds and cash coming to the fore and smoothing out that ride and helping your capital just sort of eke out a little bit longer.
We talked about, the last time you were on the show, we talked about something called phasing in, and the decision where people receive lump sum benefits either from their retirement pension or provident fund or an RA, when they get to a retirement age, which most RAs consider to be about 55 years or older. Mm-hmm. What is the conclusion for investors in terms of being able to make an investment with a large lump sum? Is it something they should go straight in and invest into the market straight away, or should they consider phasing it in? What's the sort of advice you've been giving your clients?
I think where it stands is what we try and do is maximize returns as far as possible. And if we're looking at maximizing returns, we found that phasing in doesn't sort of hold the odds for us in that instance. So if we're going to have a look at some form of risk mitigation, then absolutely phasing in can help. So again, it comes down to the risk return type debate. If you're having to go and sort of find those returns, then as it stands right now, phasing in is not going to work for you. If you're very, very tentative from the market and you're kind of going, well, there's no ways I can bring myself to going into the market right now, phasing in could be the security blanket that you need to get yourself into the market and actually start earning returns in the long term.
So regardless of, you take some of the characteristics of the person that's doing this investing, but the bottom line is that you'd prefer to go and put that money directly into the market than to take a phased approach.
Absolutely. As it stands right now. And we've got the position now where the market is fair to slightly overpriced as a whole. Okay, so that's the first thing. What we found is if we're going to start having a closer look at phasing in and the merits of it, generally when the price to earnings ratio of the market got to about 16.5 and above, then one starts saying, well, hang on, phasing in could work. So one can't be just totally negligent and totally reckless and kind of go, we'll go into the market no matter what's happening. As it stands now, where we fair value to slightly overpriced, I'm still very, very comfortable it's going to give you the favorable outcome.